Today we're going to talk about whether you should use home equity and take advantage of the low interest rates to invest in the share market. Now, why would you want to do this? Well, on average over the long term, if you look back, the returns in the share market, they're averaging 8 to 11%, depending on what markets and indexes you follow and whether you factor in tax or not. And at the moment, interest rates, they're down 2.5%, maybe even getting closer to 2%. So if you can borrow money at 2.5% and get 8% returns, even 10% returns, then on paper that makes sense. So we're going to talk about whether you should use your own home equity or any of your spare cash and look to put that in the share market. When I was posed this question, I thought about, okay, how would I explain this to somebody that is, maybe like my mum and dad, or maybe investors that maybe they've got 70% LVR on their family home, they've got a little bit of buffer, and they're really focused on building up their net worth, and they're thinking more long term. So the stance I want you to think about is start from a position of asking questions. So why do you specifically want to invest in the share market? And over and above that, why are you worried about building financial freedom, passive income? Is this part of your goals as they stand at the moment? Or do what you need to do, instead of saying, should I buy shares, is do I actually need to set some financial goals? And once I understand what my goals are and my time frame and my pathway, then I need to actually reassess, is investing in the share market part of my goal framework? So if your goals are short term and you want to maximize your gains over the next 6 to 12 months, and you've got a spare bit of equity, that might limit your options, and the share market is actually the best way for you to get in and out. As long as you understand what you're doing, just the sheer liquidness of the stock market makes it attractive to a lot of investors. But if you're thinking more long term and you're a bit more patient and you want to be more strategic rather than tactical, you might decide that it's actually better to pay down your mortgage instead of taking some of that home equity and investing it in the share market. So it very much depends on what your goals are, what your time frame is, and your level of understanding. Now, who is going to help you invest in shares? Do you have anyone that knows what they're doing? Are you going to copy someone else? Or are you kind of starting from scratch? Take my scenario. I've read 100 plus books on investing, and I still 99% of my focus, that is investment, is my own personal business stuff and property related stuff. Now, I'm not dabbling that much in the share market because I feel like I can't control much of many of the outcomes, and I prefer to be able to have influence over my investing. You might be the opposite. You don't want the burden of having anything to worry about relating to businesses or properties. You just want an easy solution, so the share market might be an option for you. So who is going to help you, and how are you going to get going? Do you even know how to open a brokerage account? Now, where are you going to invest? Now, if you are going to go into the share market, you're going to look at New Zealand, Australia, America, international markets. Are you going to use a New Zealand account? Are you going to try and use an overseas account? I know some people in New Zealand are using Sharesies in and out every day, and that can be a really easy and fun way to get into the share market. Now, there's others that are using platforms like Robinhood that aren't actually available in New Zealand, but there are ways to do it. And you can also have a look at Hatch, which does have the American share availability. Shop around. If you're only playing with 20-30 grand, then it might make sense to use a couple of different platforms until you get the hang of finding one that you like. Now, when should you do this, and what sort of investing cycle are you looking at? Are you looking at 1 week? A lot of the younger investors, especially some of the guys in my office, they're talking about shares weekly. Talking about GameStop. Some of my mates talk about Berkshire all the time. Are you thinking about 1 week, one month? Are you talking about day trading? There's a lot of risks associated with that. Or are you thinking 10, 20, 30 year mindset? You're thinking about the coffee can approach, which is to buy shares and put it away and come back in 10 and 20 years time and see how they've gone. There's a lot of evidence in some of these studies about putting investments away so that you're not scared by the volatility and not tempted to sell when shares go down, or even when you realize a paper profit, the temptation is to say, well, I bought for $1, it's currently at $2, I should take my win. A lot of times what happens is it goes from $1 to $2, and then over the next 10 years it will go to $20. Now if you sell when you've doubled your money, you might miss out on a 10x or a 100x return. So this takes me to the next topic. Now, what are you going to invest in? If you're jumping into shares, are you looking at growth stocks, value stocks? Are you talking about small companies, large companies? Are you talking about investing in IPOs? Are you looking at old established companies? Are you keen on just investing in the share market and you'll like to pick a few indexes based on momentum or growth or countries? If these things are all new concepts to you, you've got a lot to learn. It'd be very scary just picking a few stocks if you don't know the difference of what value stocks and growth stocks are, and if you don't understand the risks associated with investing in IPOs. There's some really good opinion pieces going on around my food bag at the moment. And like when you're investing in IPOs, there's a lot of hype. Now, if there's a company that you've been using or familiar with and you think, oh, I should just jump into this, I love this product, what you may miss is that the shareholders of that company are divesting out of the equity. They're actually they've put a very high bar. They're realizing their gain and they're selling you a story to say in the future it's going to be worth a lot more. Now you have to take that with a grain of salt, because if it is going to be worth a lot more, then why are they selling their shares? Now that takes me to how, we've talked briefly about it. What platforms should you use? Should you work with your bank? Should you use a platform like Sharesies or Hatch? And if you are going to be doing index investing, what are the cheap platforms? I very much like Simplicity for, it's Simplicity and it's a not-for-profit, and they're investing through the Vanguard platform, which is also a not-for-profit. So you can be assured that they're not trying to make money from you, they're just trying to make it easy. And I have it on good authority that a platform like Simplicity is going to let you take your money in and out as you please. So if all of that information is a lot of new information for you, that's very, very high level stuff, I would say you're probably not ready to invest in the share market. If all of that's, you've got that's pretty easy, then by all means start following those Reddit and Twitter forums and handles, and invest to your heart's desire. Now, if you're still thinking, I'm on the fence, what you want to really start thinking about is using mental models. Mental models are made famous by Warren Buffett's business partner, Charlie Munger. He says you've got to have a lattice work of different disciplines to help you think through challenges and problems. So a couple examples of mental models are circle of competence. So what you've got to assess is, what do I know? Now, if you don't know about Bitcoin, then you wouldn't want to be investing in cryptocurrency. Don't get caught in the craze and the hype. If you're hearing people doing well in cryptocurrency, you got to think about it as people don't talk about their losses, they talk about their wins. A lot of investors, and I say that in air quotes, investors are actually more speculators, and when those speculators do well, they tout their brilliance, and when they don't, they sometimes double down or they lock in their losses, and they talk about sports instead of crypto. Another good mental model to use is a thought experiment. So you've got to run projections out into the future. So what happens if I buy Tesla and the next day it halves, and the next day after that it halves again? If I put 10 grand into it and then 2 days later it's 2,500, how am I going to react? Am I going to immediately sell and I've lost $7,500 and I've used leverage to get that money, so I'm going to be paying for it for a long time? Or am I going to stick to my guns? I'm not going to get stressed out about it. I'm not going to check it 3 or 4 times a day. I'm going to wait and see what the market goes, because I've got a lot of conviction. You can do another thought experiment and you can say, okay, if I don't invest in shares, what will I invest in? Will I focus on my debts, pay off my car loan, or get a new car? If I add another property to my portfolio, how is that going to impact things? Run scenarios in your mind, and when you think you're done, run some more. Try to get a blank sheet of paper, write out 10 different scenarios. Don't just do things on gut. That takes me to one of my other favorite mental models, is the inversion technique. take ideas that you've got in your mind and try and dispel them. If you think something's true, like investing in the share market, using home equity and taking advantage of interest rates being so low, I think that's a great idea. Try to form the strongest possible argument against what you think to be true and to prove it false, and vice versa. And what you want to do is try and avoid the fallacy of having this strong opinion about something and not be blinded by what else is going on. And that takes me to probably what my bias is in property, because of the use of leverage. Now, if you're leveraging into shares, that's not as common, and I would say probably more risky than it is to leverage into property. Property being a tangible, more understandable, more actually needed product. Like if Tesla closed tomorrow, how many people would be affected? Like compared to the rest of the world, not that many. But if houses stop existing, who would be affected? Everyone. So you can't really touch your Tesla shares. You can print them out, but it doesn't really mean anything. But you can touch property. So leveraging into property is much easier. It's generally seen as much safer. And with all due respect to the people that think they understand the share market and individual shares, relatively speaking, I would have to strongly argue that property is much easier to understand and there's less action required. So what do I mean by that? Let's say you want to invest in 10 different stocks to have a little bit of diversification in your portfolio. That requires you to come up with 10 really good ideas, well thought out research, and to take action 10 times and to monitor those investments relatively regularly, at least once a month. Whereas if you're buying property, okay, yes, you've got to research the suburbs and the property market and the property type, but the action that you have to take on buying a property might be one action every 3, 4, 5 years. If we said you're going to buy a property every 3 years versus buying 10 stocks every year, that's one decision for property, 30 decisions for shares. Nobody is right all the time. Even if you buy the wrong property, now how marginally is that going to affect you? Maybe significantly. You got to make sure you make the right choice. But if you're buying the wrong shares and you're not even getting the same returns as the market, that's probably going to cause you a lot of stress. It's going to take a lot of time, and you may come to see that inaction in the share market might have been more beneficial. Whereas property, it's got cash flow, got capital gains. As long as you don't stupidly overpay, it's actually more liquid than people give it credit. When you're assessing whether you should get into shares using your home equity and taking advantage of the low interest rates, is just create yourself a pros and cons spreadsheet. It doesn't matter what my pros and cons are for shares and my pros and cons are for property. It matters what yours are, given your age, your income, your stage of life, given a financial assessment. And it also matters if you're thinking about using your home equity, is will the bank actually give you the money to invest in the share market? So do the pros and cons list in your own time. And if you're struggling to come up with those lists, then maybe you've got to stick within your circle of competence. There are also other options. So, okay, home equity into shares, yep, that's a really great idea as long as you understand what you're doing. But maybe there's other things that are way more important that are going to make you better returns. Paying down debt. Do you have credit cards, car loans, personal loans, even potentially student loans, even though they're interest free while you're working? And maybe it's better for you to get into a stronger position and then use your savings for shares later. Now you can use home equity to invest in yourself, further education, buy online courses, university courses, buy some books, buy some coaching, become a better version of yourself and create a new you that is able to earn more money later. One of the best decisions I ever made is I bought an online course about 6 years ago, and it was $5,500 US, which at the time was a very, very big chunk of my net worth. That course has paid dividends. I will make millions and millions and millions of dollars from that course, because what it did is it set me in the right mindset, it focused my energy, and because I put so much of my net worth into that, $5,000 US, actually more, I focused so much on getting good results out of it. So that was a much, much, much better investment than it would have been to put that money in the share market. You could look to buy a business. Maybe you want to use 100 grand of your home equity and go and invest in a local business, or buy a business that can create a salary and a dividend income for you, and it will broaden your horizons and help you learn more about things you're not working on already. Now you can improve your life. I know my better half, she's looking for new couches and she's demanding I get a new wardrobe. So should I put money into the share market, or should I listen to my wife? Now, I probably should listen to my wife and get a few things sorted before I start spending an hour each night looking at whether I should buy a Tesla or Apple or Google, all right? Now, if you're not already, you should be looking at using your mortgage in a smarter way. So if you want to use some of your savings or spare cash or whatever to further enhance your investments and get a better return, maybe just an offset account or revolving credit is actually a really good, quick, simple and safe way to get started. Also, already owned properties, instead of using that home equity, maybe what you want to look at doing is improving the cash flow on your properties by adding minor dwellings, getting renovations done, maybe subdivision development, instead of dabbling in the share market. Now, I would like to add another word of warning that when you're looking at the share market, you're competing against institutional investors, the likes of Goldman Sachs, all these big banks that they're incredibly smart people that do this full time for a living. They know what they're doing, and you have to say, okay, if these guys aren't buying these shares, what do they know that I don't know? Now, imagine trying to have a kicking contest against Dan Carter. The likelihood of success is relatively low because he was professional and he knows what he's been doing. He's doing it his whole life. So when you go into the share market, it's like competing against professionals. The speed of property versus shares is something to think about. The share market is very quick, property market is very slow. Like we were talking about before, if the share market is quick, you can realize gains and losses quite quickly, and that can be quite stressful and involve a lot of time. Whereas property is kind of, you go in waves every year or every 2 or 3 years. It's a lot of energy, get something done, and then you can kind of button off a bit. And that really takes me to like, okay, yes, financial freedom, creating financial wealth is important, but whilst you're doing it, you don't want to be in a high stress mindset and don't want to be bringing that home and thinking about it all the time. And also your time commitment needs to be factored into it. So if you're going to be dabbling in the share market and you're talking relatively small amounts of money, maybe less than 50 grand, if you're putting 500 hours a year into the share market, you have to assign some cost to that, even if you enjoy it, because you could be spending that time with your family or creating a business or on your job. So it does have opportunity costs. So let me know in the comments, hit subscribe. What do you think? Should you invest in the share market using your home equity and take advantage of the low interest rates? Or are you more focused on doubling down on what already is working for you?